So we left off talking about effectively connected income, ECI, and what I want to do is give you a practical example of how this occurs in an offshoring setting. And again, it's one of the frequent misunderstandings of how the U.S. tax system works. And so what I'm going to do is give you an example of an individual that's a U.S. person. The U.S. person, is sitting over here, and they have their U.S. company. U.S. company's profitable. The individual then says, okay, what I want to do is set up a foreign company with the idea that the foreign company can undertake some of the business activities of the U.S. company, and I can gain and defer that income offshore. So to make this workable, and I want to make it extreme, let's say that the foreign company is again incorporated in the country of the Caymans, which I'll abbreviate CAY. So mechanically how these deals normally work is some of the individuals or the people that are sitting here in the U.S. will be providing their services. So this group of people provides its services to the U.S. company, and then the U.S. company has got some customers. The U.S. company bills the customers, and the customers turn around and they will pay the U.S. company. The U.S. company then has the result of having net income. Now, the way offshoring works then is I take the individuals, and I'm careful not to transfer individuals in such a way that I'm transferring a trade or business, but simply the individuals. So maybe some of the individuals that are some key components, they get separated out from the U.S. company, right? So draw those individuals here. And those individuals separated out, they do work for the Cayman company. And as a result, the Cayman company has its customer. By the way, maybe it's the same customer, maybe it's a different customer. It has its customer. The Cayman company provides the service to the customer. The customer pays the Cayman Islands company. So on the surface, if I look at the Cayman company, let's say that it has $1,500 of gross receipts from its customers. It then has to pay its labor force, labor cost, right? And we'll just say that that is $500 to make the math work. So it ends up with $1,000 sitting in its offshore accounts. The issue that comes up is that these individuals are all sitting physically within the United States. Because they're all sitting in the United States, the issue that the company runs into is that the Cayman company is deemed to have a trade or business occurring within the U.S. What that means is that the activities of the Cayman company that are conducted in the U.S. are effectively connected. There's that word again, effectively connected with the U.S. trade or business. It therefore is going to pick up the gross receipts in the U.S., which is the $1,500. It will get a deduction for its compensation expense, but at the end of the day, it walks away with $1,000 of effectively connected income. This effectively connected income then is subject to both the corporate tax plus the branch profits tax. And what this has the impact of doing is creating exactly the same economic scenario you had with the U.S. chain. In other words, there's no tax advantage to this. And in fact, depending on mechanically how things work out, this particular structure could actually have a significant detriment over doing it directly through the U.S. But again, it's not as easy to offshore a service company because in order to do that, you actually have to move the people. So let's talk about moving people. If you do want to make a significant operational change in your business, it is possible for the individual to bifurcate the business between a U.S. business and a foreign business. But what has to happen is you have to have a pretty clear delineation between what's U.S. and what's foreign. And very specifically, you can have U.S. people performing U.S. services for the U.S. company, but if you have foreign activity, they need to be performed by foreign individuals, or individuals, not foreign individuals who are physically outside the United States. And for individuals who are physically outside the United States, it's not a U.S. trade or business. It's trade or business, but not a U.S. trade or business, therefore not effectively connected income. Now, when the customer engages the foreign company for services, the foreign company can provide the services and the customer can pay the foreign company. The foreign company then would go and pay whatever its local taxes. And in the Caymans, you know, the big news there is there is no tax, so it would have net income of 1,000, tax of 0, and still retain the net income of 1,000. I don't want to lose sight of the fact that you still run or have to run through the subpart F rules for this. Subpart F. And very specifically under the subpart F rules, you have to make sure you're not running afoul of the foreign base company services income rules. And that's covered in a separate presentation. But the idea being is that even this can get you into some anti-deferral rules if it's structured in such a way that you meet those definitions. But with a little bit of planning, you can ensure that the activities of the individuals avoid these subpart F rules, and you could actually obtain a deferral in this scenario. Anyway, that will bring us to the end of this short video, and we look forward to seeing you again.